You're now watching episode 53 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. I'm Brandon Hall, a CPA and managing partner at the Real Estate CPA. And before we get started, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description below. And if you want to take your Tax Smart up a notch, check out taxsmartinvestors.com. We've got 3 content subscriptions. You can get the basic access content to all of our articles that are all cited, and you can have better conversations with your own CPA. You get a weekly tax strategy newsletter. It's really cool. Or you can upgrade the subscriptions as well, get access to our insider group, get access to our team of CPAs, get email support, get phone call support, a lot of cool things going on over at taxsmartinvestors.com. So if you want to check that out, type that in and go and explore. Today's topic is about how the passive activity rules apply to Form K-1. So if you invest in a partnership, say that you go and put $100,000 into a real estate syndication or real estate fund, or really any type of partnership, it doesn't matter what it is. You invest in a partnership, the partnership is going to report the partnership activities on a Form 1065. And then they're going to issue Form K-1s to all of the partners that are involved in that partnership. And Form K-1 shows each individual partner's share of the partnership's activity. So the partnership, again, reports it all on 1065, and then it breaks it all down on all these K-1s and gives all of that to the individual investors. It's basically splitting up all of the income, all of the deductions, and giving it all to the individual investors so that the individual investors, the individual partners, can take that K-1 and go and report that on their own 1040s. So if you invest in a syndication or if you're a partner in a partnership, you're going to receive at the end of the year a Form K-1. And that Form K-1 is going to tell you what you need to plug into your own 1040, your own tax returns. Now, one of the most common issues that we see is that a tax preparer will take a Form K-1 from their client and they'll, whatever numbers are plugged in, they'll just throw it into the tax return, but then they accidentally tag things as passive when they shouldn't be passive, or they'll tag things as non-passive when they shouldn't be non-passive. A great example of this is when you are invested in a business that's generating real business income or real business losses, but you're not actually materially participating in that business. We're not talking about rental real estate. We'll talk about that in a second. But I put $100,000 into a hair salon. The hair salon's structured as a partnership, and every year they're kicking me back some income. But for the first year, maybe my $100,000 helps buy a bunch of equipment. They bonus depreciate all the equipment. We actually have a business loss for the first year. So when I get that K-1, maybe it shows a $5,000 loss in box 1. And box 1 is where you report ordinary business income or loss from the partnership. So box 1 on the K-1 shows a $5,000 loss. Now, if CPAs, tax preparers are not careful, or if you're doing your own tax return and you're not careful, and you go and plug that $5,000 into your own tax return, you may accidentally tag that as a non-passive loss, which means that that loss will flow all the way through to your 1040 and directly offset all of your other income. But the reality is that you have to apply Section 469, the passive activity loss rules, to the K-1 activity. And that's applied on a partner-by-partner basis. The partnership itself does not decide if a partner is actively or materially participating in the activity. You have to decide that at the partner level. So each individual has to decide, did I materially participate or did I not? Now, if I don't materially participate in the hair salon, I don't run the day-to-day operations, I don't vote, I don't discuss anything with them, I just fronted $100,000. They take it, they're expanding with it, that's their prerogative. I'm not materially participating. That's a passive activity for me. So even though there's a loss in box 1, ordinary business income or loss, it doesn't matter. That's a passive loss for me because I did not materially participate in that activity. So when I report this on Schedule E, I'm going to report this as a passive loss. I'm also going to report this on Form 8582, which is where we report all of our passive activities, income and losses, and that's where they all net out. Now let's talk about a real estate partnership. And for the purposes of this conversation, let's assume it's not a real estate syndication. So let's assume that you and I, we go and we create this partnership. We're 50-50 partners. We're buying a bunch of real estate. Now I run a business. I'm not going to materially participate, but let's say that you're more of the operations partner. So you're the one that's actually running the day-to-day. We're expanding quickly. We're growing our portfolio quickly. We're having a great time. Now we're going to report our rental real estate on Form 8825, and that's an attachment to Form 1065. So Form 8825 is a partnership's version of Schedule E. So we report all of our rental real estate on Form 8825. One mistake that we've seen folks make, preparers make, is reporting all of the rental real estate activities on page 1 of the partnership. That is not how it works. You report it on Form 8825, all income, all expenses, all that depreciation, and that's an attachment to Form 1065. So Form 1065 page 1 is going to be $0. It's going to be blank if we're not flipping properties, not wholesaling, and all we're doing is buying rental real estate. So it's on Form 8825. Then we have a net rental loss. Now, since you're working with me, and me being the tax pro that I am, I'm telling you that we're bonus depreciating everything. So we go cost segregate everything, we bonus depreciate everything. And it turns out that the partnership ends up with a $200,000 tax loss at the end of the day, thanks to all that depreciation. Now, you and I are going to split that 50-50. So you get a Form K-1 that says negative $50,000 in Box 2. Box 2 is where you report loss or income or loss from rental real estate on that K-1. So your K-1 Box 2 says negative $50,000. My K-1 Box 2 says negative $50,000. I'm pretty sure I just messed that up because we were talking about a $200,000 tax loss. So yours would actually say negative $100,000. Mine would say negative $100,000. But that's in Box 2 on the K-1. The mistake that we have seen CPAs make and tax preparers make is they get that K-1, they see the negative amount in Box 2, and they automatically assume that that is a passive activity. But you're the operating partner. You are actually a real estate professional when we go in and apply all the Section 469 rules. So in reality, even though that loss is in Box 2 for you, you should have a non-passive loss, and that should flow through to your 1040, and it should offset your W-2 income, and it should offset your business income. Now, this is just an example. I have no idea if you are actually a real estate professional, but for the purposes of illustration, the point is that the K-1 does not show you whether or not you materially participated. The K-1 does not report on the passive activity rules. My K-1 and your K-1 are identical, but my K-1, my negative $100,000, that is a passive loss for me. Your negative $100,000 is a non-passive loss because when you apply your own facts and circumstances, you recognize that you're a real estate professional and you make all the grouping elections and all that fun stuff. So the point is, when you get a K-1, pay attention to where things are reported, but also remember the passive activity rules. Remember Section 469, and remember that you apply that yourself. The partnership is not going to determine that for you. Thanks so much for tuning into today's Tax Smart Daily video. Hope you enjoyed it. If you have any comments or questions, drop me a line below. I love engaging with our community. And check out all the social media links that we have below. We're all over the place, and we'd love to have you be part of our larger community.